Let's talk about gold. For centuries, it's been the ultimate store of value, right? The go-to hedge against uncertainty. But for anyone who needs income, it's always had this one giant problem. It doesn't pay you anything. It just sits there. But what if that could change? What if you could actually get paid by your gold? And that idea leads us right into this huge question, especially for retirees. You could call it the retirement dilemma. How in the world do you get both safety and a steady income stream when finding either one is getting tougher and tougher? All right, let's dive in. So, to really get why an investment that promises income from gold even exists, you've got to understand the pretty tough financial world that a lot of retirees are navigating right now. I mean, the traditional playbook for retirement income, it's under some serious pressure. Those super safe, high-quality bonds, well, they're just not paying what they used to. Meanwhile, inflation is this constant threat, quietly eating away at your savings. The stock market can feel like a total roller coaster, and even those reliable company dividends aren't guaranteed. They can get cut when things get rough. This is exactly where gold has traditionally stepped in. It's that safe haven asset, that hedge. But like we said, it's got that one massive drawback for anyone needing cash flow. It pays zero income. It gives you no yield to help cover your expenses. But what if gold could learn a new trick? Well, that's where this pretty interesting and relatively new ETF called IGLD comes onto the scene. It promises to tackle this exact problem by trying to blend gold exposure with an income stream. So what is IGLD? Okay, the full name is the FT Gold Strategy Target Income ETF. But here's what you really need to know. It's an actively managed fund with a very clear goal. It wants to give you a monthly income while also letting you get in on the price movements of gold. And this right here, this lays out the fundamental trade-off perfectly. With a traditional gold fund, if gold's price skyrockets, you get all of that upside. The con? Zero income. With IGLD, you get that monthly income stream, but, and this is the big but, your potential for growth is capped. You're basically swapping some of that potential upside for income right now. Now, I know what you might be thinking. This sounds a little bit like financial magic. How on earth do you squeeze income from an asset that doesn't produce any? So how does this thing actually work? Let's pop the hood and take a look inside IGLD's income engine. It's a really clever three-step strategy. So step one, the fund doesn't actually buy and hold physical gold bars. Nope. Instead, it holds super safe stuff like short-term U.S. Treasury bills. Then, step two, it gets its gold exposure using derivatives. These are basically contracts, in this case options, that are tied to the price of gold. And then step three, this is the crucial part. It sells other options to generate cash. That cash is called a premium, and that's the income that gets paid out to you, the investor, every month. This chart really drives the point home. If you look inside IGLD, you'll see that about 98% of it is just sitting in U.S. Treasury bills. All the action, the gold exposure and that income generation, it's all happening in that tiny 2% slice of the fund that's dedicated to options. Of course, a complex strategy like this isn't free. It comes with a price tag. The annual expense ratio for IGLD is 0.85%. And that's a really key number to keep in your head, because that's a hurdle the fund's performance has to clear every single year just to break even on costs. Okay, so what does this all mean for an investor? It's time to talk about the big picture, the trade-offs. What are you really getting with IGLD? And just as important, what are you giving up to get that monthly check? All right, on the strength side, you're getting income from gold, which is totally unique. It can help diversify your income sources away from just stocks and bonds. But the risks, well, they're significant. That cap on your upside potential is a really big deal. And crucially, you still have full downside exposure if the price of gold tanks. The fund itself is also pretty complex. And like we just saw, that expense ratio is on the higher side. Look, if you take only one thing away from this, let it be this: that monthly income is not a buffer against losses. I'll say it again, it's not a buffer. If the price of gold drops 10%, you can expect IGLD to drop right along with it. The income might soften the blow a tiny bit, but you are not protected from the downside. Okay, so given these very real trade-offs, how might an investor actually use a product like this? Let's shift from just talking about how it works to how it might fit into a real-world portfolio. The research we looked at puts it perfectly. A fund like IGLD is best thought of as a satellite or augmentation holding, What does that mean? It means it's not meant to be the core of your retirement plan. Think of it as a smaller, supplemental piece you add for a very specific reason. In this case, to get a dose of income that's linked to gold. So what does that satellite role actually look like? This table gives you a few ideas. And notice something here. Across all these different portfolio types, from conservative all the way to more growth-focused, the IGLD allocation stays a pretty small slice of the pie. We're talking 10 to 15%. It's designed to be an enhancer, not the main engine of your portfolio. And all of this brings us right back to that central question we started with. Is trying to squeeze income out of gold really worth the complexity, the cost, and giving up that unlimited upside? You know, the answer is going to be different for every single investor. But now you've got the framework to think critically about whether a strategy like this makes sense for your own financial goals.